All right, today we're going to unpack a really huge battle that's happening behind the scenes over the rules that govern our biggest banks. It's called the Basel III Endgame, and trust me, it's a fight that could end up affecting everything from your mortgage to the stability of the entire financial system. So before we get completely lost in all the jargon, let's start with a really basic question. What actually keeps your bank from going under? It's not the cash sitting in the vault. Nope. The real answer is something called bank capital.
Now, bank capital isn't your deposit money, it's the bank's own skin in the game. Money from its shareholders and from its profits. The best way to think about it is like a giant financial cushion. It's the buffer that absorbs losses when loans go bad or investments tank. The bigger that cushion, the safer the bank is, and the less likely you and I, the taxpayers, are on the hook for another bailout. And the size of that cushion, that is exactly what this whole fight is about.
Okay, so here's our game plan. We're going to start with what this endgame thing even is, then look at why we need it in the first place, get into the core debate it sparked, see how it's playing out globally, and finally, figure out where this whole story is heading next. So, first up, what is this endgame? Well, put simply, it's a brand new set of rules proposed by U.S. regulators that would basically force the biggest banks to hold a much, much larger safety cushion of their own money. And this isn't just some idea the U.S. came up with on its own. It's actually the final chapter, the end game of a massive global agreement called Basel III, which was born from the ashes of the 2008 financial crisis. The whole goal is to tie a bank's capital requirements directly to the specific risks it's taking on. The U.S. version of this hit the table in July 2023, and it targets every single bank with over $100 billion in assets.
But why do we even need these new rules? Well, they weren't just created in a vacuum. Their story, it was forged in the fire of a global crisis that pushed our entire financial system right to the edge of collapse.
This has been a long, long time coming. While the groundwork was actually laid decades ago, the real catalyst, the real trigger, was the 2008 financial crisis. It became painfully obvious that the world's biggest banks just didn't have enough capital to cover their own massive risks, which led to, you guessed it, taxpayer bailouts. The Basel III framework was the immediate fix, and this end game is supposed to be the final piece of the puzzle.
And this brings us right to the heart of the conflict. This proposal has kicked off an absolutely fierce battle between two totally opposing viewpoints. Do we want a safer financial system, or do we want one that's less expensive for everybody?
So on one side, you have the regulators. They argue this is all about an ounce of prevention. Force banks to have more skin in the game, and they'll be less reckless and better able to handle shocks without needing a bailout. But on the other side, you have the banks. They're saying this is a cure worse than the disease. They warn it's total overkill that'll make all kinds of loans more expensive and just push risky behavior into the unregulated shadows of the financial world.
And this is the voice of the regulators coming straight from the top. Federal Reserve Vice Chair Michael Barr, who's a key architect of this whole proposal, puts it very plainly. For him, the crucial point is making sure banks are held responsible for the risks they choose to take on. Simple as that.
But, and this is what makes this debate so fascinating, the opposition isn't just coming from bank lobbyists. This quote is from Christopher Waller, who is another governor on the Federal Reserve's board. He actually voted against the proposal. He argued it would hurt the economy by jacking up the cost of credit, all without a clear benefit to safety. That division, right there at the very top, shows you just how contentious this whole thing really is.
So why should you or I care about this high-level regulatory squabble? Well, because the banking industry argues it could have very real effects on your wallet. They say that forcing banks to hold on to more capital could make everything from a mortgage to a credit card to a small business loan more expensive. They also warn it could push people, especially those with lower incomes, towards non-bank lenders that often have way fewer consumer protections.
Now we have to remember, this whole thing started as an international effort to create a level playing field for banks everywhere. But as countries actually start to put these final rules into practice, the story gets a whole lot more complicated. It's turned into a real global balancing act. The goal was supposed to be a single global standard, but that's really not what's happening. The U.S. plan is basically stuck in the mud, facing major revisions. The EU is moving ahead, but on a much slower timeline, and with its own special adjustments. And the UK? Well, they've hit the pause button, basically waiting to see what the U.S. does next. The result is that this level playing field is starting to look anything but. Which brings us right to today. And far from being the endgame, this whole process is looking more like it's headed into sudden death over time. The future of these rules is, to put it mildly, very much up in the air. The most important thing to know right now is this. The intense backlash from the banking industry, from politicians on both sides of the aisle, and even from some regulators themselves, well, it worked. The original proposal, as it was written, is effectively off the table. U.S. regulators have been sent back to the drawing board. And hey, you don't have to take my word for it. The head of the Federal Reserve himself, Jerome Powell, admitted back in March that he expects broad and material changes to the proposal. I mean, that's about as clear a signal as you can get from the top that the original plan is being completely rethought. And this leaves us right back at the fundamental dilemma, the core trade-off at the heart of all financial regulation. Look, we all want a banking system that's 100% safe and can never, ever fail. But trying to achieve that perfect safety might mean making credit so expensive and so hard to get that it grinds the economy to a halt for everyone. Finding that perfect balance is the real endgame, and it's a challenge that regulators are still grappling with.
This is not financial advice.